Hello and welcome to a brand new show of Market Makers Crystal Gazing. Now the year 2013 has been a year of twists and turns for Indian equities. When we started the year, Indian equities or Indian markets were trading at the top of the heap. Now we are trading at the bottom of the heap. What has worked for us of late is a sudden crack in global commodities. What is not working for us is growth. In the near term, risk versus reward. How should one map the current market environment? To discuss that, on this edition of Market Makers, I have a very special guest, Ravi Dharamshi of ValueQuest. Ravi, it's your first time on Indian TV, so a very warm welcome. Thank you for joining us.
Thank you so much. Thank you for having me.
Let's first talk about the broader market environment. My introduction, I guess, was the question in itself. When we started the year, we were trading at the top of the heap. Now we are trading at the bottom of the heap. What is going on?
The bear market for Indian equities started in 2008, and we are in our fifth year of bear market. Our understanding is that in terms of prices, the markets bottomed out in the year 2009. In terms of sentiment, it was really bad in 2011 when we thought that government is not doing anything. There were scams all around. So sentiment bottomed out in 2011. In 2012 saw a huge gush of FII flow. But yet there is the confidence of market being in a bull market is lacking because in the year 2013 the economic data is still coming out bad. The quarter earnings result are still yet to bottom out. So I believe 2013 calendar year or maybe maximum FY14, the financial year 14 will witness the bottoming out of the economic data as well as the earnings cycle. And once that happens, then maybe we can have a more sustainable uptrend. Till then, we are likely to remain in a range.
My understanding is that at the current juncture, a lot of hope is building in. And unfortunately, hope is not a data point. There is hope that Reserve Bank of India will cut rates. There is hope that government action will continue. The new hope is that commodity prices will only come down. Do you think expectation management will be a big challenge?
In the last quarter of the previous year, government completely stopped spending, because of which I'm sure there is a lot of pent-up demand. And I believe they'll front-load the expenditure in the current year. If that is the case, then I think it's a little more than just hope that we are clinging on to. There is evidence that the action has been taken. Is the action enough to pull us out of this falling GDP? Maybe not yet. But it surely will give a cushion at some point of time, and the natural resilience of Indian economy should come into effect sometime this year.
So at a time when you are of the view that maybe the worst is behind us and markets are poised to go higher, not in the short term, but maybe in the medium term and in the long term, what is your portfolio strategy? How are you allocating in order to maximize returns?
So we are completely invested. Any cash that we would have generated is more tactical in terms of switching from a stock to another stock. But our strategy is to stay invested. In terms of where the exposure is, at this point of time we have exposure to private banks, NBFC, some digitization play like broadcasters. We have some exposure to agriculture since agri has gone through a bad time in the last couple of years, and some auto anchors. That is how we are structuring at this point of time. We believe over maybe next 12 months, our portfolio is likely to move from a more from defensive to being a little more aggressive as the signs of recovery emerge.
But private banking, I understand, is the core of your portfolio. What makes you so bullish on private banks? Most of the private banks are trading at historic highs. And again, the valuation argument at the current juncture may not be favorable for some of these key names you own.
Surely. Interest rate cycle has for sure peaked out. Whether we are going to witness another 50 bips of interest rate reduction or 100 bips is debatable. NPA cycle, I believe we have seen the worst in terms of for the private banks. For PSU banks, we might still have some worsening asset quality. And also these NPA concerns are emanating again from the mistakes made during 2007-8. Since 2009, a lot of banks, if I were to take an example, ICICI Bank has been constantly trying to slow down its growth and bring its balance sheet in shape. So we are in the third year of transition where these banks are trying to mend their ways. So I believe that in terms of asset quality, the banking is close to bottoming out. In terms of interest rate cycle, we have peaked out. So going forward, once the economy picks up, even banking is a proxy to the GDP growth, even that will pick up. And the margins have already bottomed out for a lot of players.
Now you have a large exposure to IndusInd Bank. The stock has done exceptionally well. Growth has been stellar. IndusInd Bank is now part of the Nifty 50. For a bank of that size, do you think this is as good as it gets?
I do not agree with that. I think it's definitely a beginning of a new inning for IndusInd Bank, as it is becoming more mainstream than it was, say, 5 years back. But the way it is performing, the way consistently it is churning out good numbers and managing the current downturn. If private banking is to grow, I believe IndusInd Bank has a leading role to play.
Do you have a price target for IndusInd Bank? Do you think it is the poor man's HDFC Bank?
I would like to see IndusInd Bank as IndusInd Bank and not as HDFC Bank. Price target, we do not work with price target, but I see enough valuation comfort to suggest that there is absolute returns even from here at this point of time.
Right. The CEO of IndusInd Bank told me that IndusInd Bank has managed to grow at a run rate which is much higher than the industry average for 20 quarters in a row. Do you think they can sustain this feat for another 8-10 quarters?
I have no reason to doubt that that is unlikely to happen. If they have managed the way they have managed in the last few years, for sure, when the growth returns, the business is theirs to take.
ICICI Bank is another one of your core holdings. It's a great franchise, great network, very strong CASA ratio, but NPAs could be a concern. They have a large exposure to power, large exposure to the core sectors which are under threat. So at the current juncture, what makes you bullish on ICICI Bank? Attractive valuations, or you like the business or the positioning of the bank?
It is the largest bank out of India, apart from State Bank of India for sure. And the valuations, as you said, are cheap. The balance sheet and the fundamentals are undergoing a correction since last 2-3 years. It has subdued ROEs at this point of time, and margins have in this quarter for the first time come above 3%. ICICI Bank used to consistently quote at 3+ book value in its heydays. So there is a lot of margin of safety in terms of valuation.
But that was a different era.
And it is an improving wicket. So yes, the restructured book and NPA is a concern, which is why the valuation re-rating is not happening at this point of time. Even 8 quarters of good performance is not enough. Another 8 quarters of good performance, maybe the market will recognize it differently.
You have exposure to agri. That is more like a contra bet, or you are pretty comfortable with the dynamics of the Indian agri sector? Because for those who bought agri stocks directly, indirectly, they pretty much are stuck with them.
The agri economy has gone through a slow patch in the last 2 years because of the monsoon. But we believe the agri theme is a secular theme. India has no choice but to improve its farm productivity. The best way to do that is through seeds, agrochemicals, and we continue to believe that if this monsoon is good, for example, just the reversion of mean in agri growth will ensure that the agrochem growth and seeds growth comes back. So we have a lot of belief in the secular story of agriculture, and the valuations have become cheap now because of the last couple of years of bad performance.
Let's elaborate more on that part. When you say valuations are looking attractive, what is looking attractive?
At this point of time, we have exposure to agri through Rallis and Jain Irrigation. Rallis, for 3 years in a row, it is stuck in the band of 6 rupees and 7 rupees EPS. The stock is right now quoting at 120 odd. It would look as if it is quoting at 20 P multiple, but I believe these earnings are unnaturally suppressed, and they have seeded lots of new businesses like seeds, like distribution business on the pulses side, and and those businesses, and they have a new plant that has come up, and those businesses are yet to start contributing to the bottom line. So a good monsoon and new businesses start contributing, suddenly the 6 rupees EPS will look like 9 rupee EPS, and then 120 will not look so expensive anymore.
So Rallis, to your mind, is at some kind of an inflection point?
It's a matter of time. If this monsoon is good, I don't think Rallis will be again available at 100 or 110. That's my belief. That's absolute rock bottom.
Jain Irrigation, a bombed out stock. The management has been criticized in the past for poor capital allocation. This stock, had made a fashionable comeback 4 years ago, but now it is languishing. Why is that?
The reasons are quite apparent why Jain Irrigation is disliked. And this is...
markets, they just love to hate the stock for some strange reason.
This is a contra bet to that extent. We believe that the irrigated land in India, the portion of irrigated land in the total arable land is bound to go up over the next 5-7 year period. Jain Irrigation is the #1 player by a wide margin and likely to remain that way. So we are very bullish on the micro irrigation space, and there is no better play available. The problem with Jain Irrigation is it is dependent on subsidy, and it has, because of which the working capital is very high, and they had taken a lot of foreign loans for that. So now they have replaced those high cost debt with some low cost debt, so some comfort on the debt front. They have tried to address the issue of the high working capital by forming their own NBFC.
Market insiders are telling me that as a house you are negative on pharma, and the reason why I'm asking you this question is because as a house you were the first one to identify the pharma generic opportunity way back in 2001-2002.
Let me qualify the question a bit. I won't say that I am absolutely negative on pharma, but I would say that the easy pickings are not there anymore. The story that everybody hears is the generic patent cliff opportunity in US. Any player of any size who wanted to be present in US is already there. The competitive intensity amongst the generic is increasing. At the home front, now the doors are getting closed in terms of opportunity of genericization of new drugs. So, and developed market is a different ball game. For smaller companies who do not have the wherewithal to fight the marketing and the legal challenges in a developed market, they'll find it very difficult. Can they hit jackpot with one particular drug? It could happen, but making it and converting it into a sustainable business model is going to be challenging. So I would be careful of choosing my stocks in pharma. Otherwise it remains an evergreen sector. Nobody is going to stop eating drugs or pills.
If I look at the Nifty 50 basket, from the Nifty basket, the 3 stocks you own are #1 IndusInd Bank, second ICICI Bank, and the third one is Lupin.
That is correct. Lupin is still a good enough story to give a 20% CAGR return. It is an old investment for us. So
it's been what, a 20x for you already? Or more than that?
I lost count, but something like that. We have been holding it for quite a while.
And you plan to hold it further?
Yes, I don't foresee Lupin's earnings tapering off or sales tapering off at this point of time. I think they have a good differentiated strategy in place in US and Japan, which is different from most other companies. So I think Lupin has a bright future ahead, at least for the foreseeable 3 to 5 years.
What I know about your firm is that you always believe in concept ideas. You always believe in focusing on where the puck could move, not where the puck has moved. And just for the benefit of our viewers, as a house you identified IT way back in 1999. It was pharma in 2002-2003, followed by engineering. Are you betting on a concept? Are you betting on any sector or group of stocks which to your mind are at a very embryonic stage and now things could really multiply for them going forward?
At this point of time, as I told you, we have exposure to digitization through broadcasters and agri theme through Rallis and Jain irrigation. I think the story is still to play out in these sectors. Whether or not digitization is going to happen, that's not a question anymore. Digitization with some delay is for sure going to happen. The money collected by LCO, will it flow back to the MSOs and the channels? I think even the probability over there is pretty high. There can be delays.
So you like broadcasters?
I like broadcasters, and I think they are going to have a 2x, 3x jump in the profitability in the next 3 to 5 years.
I would love to discuss names with you, but with media, I always like to give it a skip. Let's look at one sector which honestly has surprised us, surprised everyone on the upside, which is the FMCG sector. Unilever has just indicated that they want to increase their stake in HUL at a wildly expensive P multiple. What does that mean for the entire sector? And do you think this is some kind of an endorsement that we should not underestimate the brand power of Indian companies?
It is a very, very interesting development that has happened. And HUL is not the first one. We have had GSK Consumer doing that. And they also did it at a 30% plus premium to what the prevailing price was. The way I look at it is, this is as much as an endorsement of their brands, it is as much an endorsement of India is the last standing consumer market in the world. US is past its prime in terms of consumption. China has had 20 years of good run in consumption. So India is which is 1/6 of the world's population and which is coming out of poverty and moving up the wealth ladder. This is where the next 20 years of consumption boom is going to happen. So I think it is precisely that. Unilever management and Glaxo management see this as the best use of their funds. If they are looking, their horizon is not 1 year, 2 year, 5 year, and so from a 20-year point of view, there is absolutely no doubt this is where they are going to make money.
So critics who find Indian FMCG stocks expensive, should they think again?
They are expensive. They are right. It's a different time horizon that is the problem. If you are a really long-term investor, then the valuations, the expensive valuations will correct itself over a period of 1 year, 4 to 8 quarters. So I don't think they are so expensive that we can have a big bear market in the consumption stock, barring a odd stock like Jubilant Foods, which is highly valued. So yeah, I don't think they are unsustainably highly valued. They are on the expensive side. It is recognized that they have economic moat, they have pricing power, and they do not require capital at this point of time. So why should an investor sell out?
You are in active money management. It's a very competitive space. How are you planning to differentiate, and what is your key differentiator?
We believe that Indian equities have a long-term potential. That is a must for us to start this business. The way we differentiate ourselves is we have a very concentrated portfolio approach. We do not like to hold more than 10-12 stocks. It's a double-edged sword. If we go wrong, the portfolio can take a hit. We also like to put our money where our mouth is. So if I believe that agri is the next theme, that is where I'm going to put my money. Another way in which we differentiate ourselves is we take a longer term perspective. We try to educate and handhold our clients through the shorter term market corrections. As I told you earlier, I believe the risk reward ratio is favorable for equities from a 5-10 year point of view. So even in case we have a correction, I think that will be more a quotational loss than a permanent capital loss. The risk is not of allocation to equities. The risk is in terms of wrong stock picking probably, or in terms of maybe opportunity loss from 6 months, 12 months point of view if markets do not perform.
So how would you summarize the India story? What is the India story? Consumers, exporters, brand owners, resource companies?
The overarching theme for us is definitely consumption. India is a $1.8 trillion economy. At this point of time growing at 4%, but I believe we can grow 8% and maybe even higher. So over a 7-8 year period, we can hope to be a $4-5 trillion economy. If that is the case, then we'll be saving 20-25% of that. There is a lot of money that is going to flow in. We have crossed the hump of $1,000 per capita. So once we keep moving up that chain, the discretionary spend is only going to rise. And we are going to buy things. What things we are going to buy and which are the companies positioned to take advantage of that is the question that we keep asking ourselves constantly. This theme will manifest itself from time to time in various sectors, whether it is FMCG or whether it is consumer durables or some other indirect play.
But the three pillars you're betting on, one is private banking, second is agri, and third is digitization.
And they are all essentially a manifestation of consumption play on India.
You've identified several multi-baggers in the past. At the current juncture, do you have enough visibility to identify multi-baggers, or right now the quest to find multi-baggers is not on? You're only trying to find stocks which could be 2x or 3x.
Whether the stocks are multi-baggers or no is known in hindsight. When you are buying, you can only be sure about the valuation that you are buying and that it has a bright future. You can paint certain scenarios. So, for example, if I'm telling you digitization, I think they are for sure 2-3 baggers from here. Is there a case that they become bigger? That all depends on how the ARPU moves. That all depends on how is the market growing further or not.
So bet on the opportunity, pick up the best stock and pick up a company which has a reasonable brand presence.
And keep evaluating if the story has peaked out or not.
At the current juncture, what are your classic buy and hold ideas? Give me a list of just 3 names.
I'm going to tell you what I have bet on, so, and with the disclaimer that I have vested interest. Private banking, NBFCs, but well selected NBFCs, not across the board. So NBFC sector is actually undergoing a lot of stress or a lot of changes because of what Usha Thorat committee has recommended. But I still believe that the business model can sustain itself. And the names, I would say ICICI Bank, IndusInd Bank, and then the maybe NBFC side it would be M&M Finance or Sundaram Finance.
So just to summarize our discussion, at the current juncture, your view is that in the near term, the risk-reward ratio is favorable and going long. As a theme, you're bullish on agri and digitization, and in terms of a sector, you're bullish on private banking.
That's absolutely correct.
Any disclosures before we wrap?
Yeah, it is safe to assume that any stock or sector we might have discussed that we as a firm and our clients would have exposure to it or have vested interest in it.
You've told me your portfolio, you've not told me your largest holding.
We have mentioned it a couple of times. It's
for our viewers to guess.
Yes.
Okay. Really appreciate your time. Thank you very much. Thank you for your lovely and robust insights.